Tired of ads interrupting your gripping investigations? Good news. Ad-free listening on Amazon Music is included with your Prime membership. Ads shouldn't be the scariest thing about true crime. Just head to amazon.com/ad-free true crime to catch up on the latest episodes without the ads. Enjoy thousands of Acast shows ad-free for Prime subscribers. Some shows may have ads.
Shares for beginners.
When people don't explain their reasoning, it's possible for them to say these cryptic things, saying, I meant it, I didn't mean it, you misunderstood. Okay, enough. Give me, I think stocks are going up because, and then explain your reasoning, right? I think this stock is going down because, explain your reasoning. And once you do that, it's impossible to do the broker's trick of telling half the people it's going up, half the people it's going down. Okay, we were right. See, we're geniuses. We were wrong. We were kidding. We didn't mean it. I have no time or patience.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How much debt is the world in right now? Are some countries doing better or worse? And has anything changed since the midterm elections? It's my pleasure to welcome back to the microphone Gary Brode from Deep Knowledge Investing. Hi, Gary.
Hi, Phil. Thanks for having me. Great to be speaking with you.
Now, Gary spent 30 years in the securities industry. Most recently, he was managing partner and senior portfolio manager for Silver Arrow Investment Management, but now with Deep Knowledge Investing. So let's start by talking about the election roundup. And we're recording on Tuesday, the 15th of November, so we don't know what the actual result is just yet. What's the election look like to you?
Thanks. It's a great question. The obvious is the red wave that people were talking about didn't materialize. As of now, it looks like the Republicans are going to have control of the House and won't have control of the Senate. The Senate's going to be 50-50 or, 51-49, probably for the Democrats. So the Republicans will have more control than they did going into the election, but not as much as they had hoped. Right or wrong, the election was viewed as a victory for Democrats and for the White House. And it's not that they had a great night, it's they had a great night versus expectations, which is reasonable and fair. So they lost seats, but not as many as they had hoped to. And so you had, Joe Biden, who he came out recently and said, he's going to be selling oil from the Strategic Petroleum Reserve at 90. He's setting a $70 floor. He's going to buy oil at 70. First of all, I don't think anyone in the White House knows how difficult it is to trade commodities. And I'm 100% certain there's no one in that building with the expertise to do it properly. That said, the commodity trader in chief came out the day before the election and he said, we are going to shut down the fossil fuel business. And then he came out the day after the election and said, hey, we had a good night. I'm taking this as validation of my policies. So more of the same, we're not changing a thing. And so, my response to that is, okay, fine. But if we're not going to permit land, if we're not going to drill, if we're not going to produce the energy the country needs, then I want to own the existing production. I want to own the places where there are permitted wells, where there's, LNG, liquid natural gas production. You want to own the refiners. Basically, what we're looking at is 2 more years of insanely high energy prices. And so, my response is whether you like the policy or not, I want to own energy here.
So there's this dynamic going on at the moment about energy, that fossil fuel production needs to be shut down. Has this been driving inflation up until this point? Because a lot of the words that come out of the White House seem to be suggesting it's just about the Ukraine war. It's not about their own policies.
The fact is, energy prices, gasoline prices were spiking well ahead of Russia going into Ukraine. The second thing is Russia's still producing oil and gas. Right, they're just not distributing it to Europe, and that's not as efficient. Obviously, there's nothing more efficient than a pipeline, and you end up with issues when you reroute supply lines. You can end up with issues on refining, but the fact is, these issues existed in energy prices before Russia went into Ukraine, and Russia is still producing oil and gas. The other thing that we're seeing here in the United States is one of the reasons why gasoline prices are so high is because of what we call crack spreads, right? That what we're short on oil, but we're really short on refining capacity. And so crack spreads, which is basically the amount of money that the refiners make to turn raw commodities into distillate, like gasoline or airplane fuel or diesel, those spreads quadrupled this year. And so some huge part of what we're seeing is a result of too little refining capacity. Now, nobody's built a refinery in the United States in decades because that's a multi-billion-dollar, multi-year project. And so, Phil, let me ask you, if you were a US refiner and you're making a ton of money because demand is off the charts high, but everybody, the commodity trader in chief is saying, we want to close down your business. We want to shut you down. We want to make sure nobody's producing fossil fuels by 2035 or, whatever this week's date is. Would you build a multi-billion-dollar, multi-year refinery?
It doesn't sound like certainty to me.
Right. And, we end up with these ridiculous supply-demand issues. And so, the White House recently, they were angry at the oil companies for not producing more, leaving aside the fact that they haven't permitted more land for drilling. Okay, fine. But, they ran for office saying, we're going to close down this business, and then said, we're angry that you're not producing more and it's your fault that prices are too high. But again, why, if you were a US producer, why would you be investing in that when the people in charge are flat out telling you, we want to put you out of business?
Haven't they also been talking to the Saudis and to Venezuela to sort of reduce sanctions perhaps and try and thaw relations just so that they can get more oil imported?
Yes. So the White House has gone with a three-part strategy. The first was to ask the Saudis and OPEC to produce more. And they came back and they realized it was an election ploy. And they said, not only are we not going to produce more, we're cutting production by 2 million barrels a day. So that, that resulted in a quick no. And then the White House went to Iran and to Venezuela and said, hey, can you guys produce more? We'll lift sanctions. We'll make life easier for you. And I'm looking at this thinking, what in the world? We're going to terrorist dictatorships, communist dictatorships. We're going to OPEC. We have plenty of oil. We have an enormous amount of production capacity, great technology here. And we're trying to shut down US-based drilling and refineries while trying to send money to Iran, Saudi Arabia, and Venezuela. I mean, this is completely insane. And on top of that, at the same time that the White House is saying to the US oil companies, we want you to produce more, they're saying we're also considering windfall profit taxes. So Phil, quick economics quiz for you. If somebody says, hey, I'd like you to produce more, but just so you know, while you're in the middle of ramping up that production, we may come up with a whole bunch of insane, unexpected taxes, windfall profit taxes. We want to make sure you don't really make a lot of money from this. Phil, are you going to start drilling? Are you going to invest in that infrastructure?
That's a wild situation, isn't it? What do you think the long-term future is for energy prices and then, of course, the effect on equity markets?
Yeah, so that's a great question. The effect on the equity markets is no longer what it used to be. So if you go back to like the 70s, early 80s, I think energy made up something like 30% of the S&P 500. Now it's something like 3%. And for everyone listening to this who's been frustrated by high electric bills, by huge expenses to put gas in your car or, all kinds of other very expensive inconveniences and hardship that people have had because energy costs are so high. One of the ways that we deal with that is you might as well own the other side of it, right? So I get my electric bill and it makes me mad. And I go fill up my car with gas and it makes me mad. And I get my heating oil bill and none of that is pleasant. So my response is, okay, well, I'm going to own the energy companies. I'm going to own the companies. I'll at least sell myself the oil at inflated prices. And so one of the things I would encourage your listeners to do or just to think about is there are always solutions. There are always answers to these things. Not everything that happens in life will be good. You won't agree with all of it, but there's always a way around it. There's always a way to be creative, to make money from it. And it's, it's the same thing. Earlier in this conversation, you were asking me about politics and about elections. And, half the country likes the results, half the country doesn't like the results. That's fine. Don't spend a lot of time being upset about it. Figure, okay, if these people are the ones in charge, what policies are they going to pursue? If they pursue those policies, what stocks are going to benefit or get hurt, and just find a way to make money from it. And our view is that we should be endlessly creative, flexible, adaptable, roll with the changes and figure out what do we do now. And it's the same thing with fuel. The prices are bad, but they're not going to get better, because for things to get better, you'd really need an increase in energy production. And somebody tell me where that's coming from.
And something else that you've been writing about, and following you on Twitter is always good. So I'd encourage everyone to follow Gary on Twitter and read some of his material. And that's about the effects of ultra low interest rates. Tell us about that.
Yeah, and thanks for the pitch there, Phil. It's Gary_Brode on Twitter. Would love to have your audience there as well. So
we'll be putting that in the episode notes as well, so people can
terrific.
People can lurk and find you and start stalking you.
I appreciate it. Thanks. So you're talking about ultra low interest rates.
Mm-hmm.
And it creates a few problems, right? One is you have a huge misallocation of capital. And a lot of people don't really think about interest rates as, well, that's what you pay on your credit card, or that's what you pay on your mortgage. And it's just sort of this thing that exists. So let's just take a minute, everybody, and take a step back and think about, what does interest really mean? And it's how the financial market set the price of risk and the price of time, right? Like, really think about it big picture. It's the price of risk and time. And normally the market sets that rate, and that would be the right way to do it. Now what we have is groups of worldwide unelected bureaucrats who have never held a job doing that. And take a look, the Federal Reserve, it's populated by people, I'm sure, with very high IQs, but none of them have ever run a business. So you end up with allocations of capital that are not ideal. And projects get funded that shouldn't be funded because people are desperate to do anything to earn a return on capital. And, there's an old saying that, and I forget, it's a British saying, and I forget who the standard hypothetical British person is, but in the United States, we'd call him Joe Sixpack.
Mm-hmm.
And the old expression is, Joe Sixpack can handle anything, but he can't handle 2%. And the point is, if interest rates drop below a certain point, usually around 2-3%, people will start looking for crazy things to do with their money. If people can earn 5-6% in a savings account, they say, okay, my money can compound, I'm all right. And so you have this crazy misallocation of capital, and businesses that shouldn't get funded do, and it soaks up capital. We also see it in terms of zombie companies and government debt as well. And so, imagine for a minute that, you and I are running a government. And let's say, we've got our own Federal Reserve, our own central bank. And so, Phil, you and I say, well, what do you think the rate of interest should be? And we say, oh, 0. Let's not pay any interest. And somehow the bond markets accept that. So how much debt do you want to issue so that we can give everybody free stuff? $1 million, $1 billion, $1 trillion, $10 trillion, right? The answer is, we don't have to pay interest on it. So let's run up the credit card. It's not costing us anything. It won't screw up our budget. And so you have governments taking on massive amounts of debt. Well, the problem is now we're at the inflationary part of the cycle. And the way these same central banks deal with that is they increase interest rates. And this is what we're seeing now. And all of a sudden, it becomes a really big deal when, your on-balance sheet debt is $31 trillion, or when you're Japan and your debt is 260% of GDP. Now, all of a sudden, when that debt reprices, it's going to blow a hole in your budget. And that is a huge problem. And so when people look at Jerome Powell, the current chairman of the Fed, and he views Paul Volcker as the sort of the model to look at here. But Volcker was able to raise interest rates so much because the debt the United States had back in 1979 wasn't that high. But now, you start to raise interest rates and you blow a hole through the budget. And we're right around the point where when US debt reprices, all tax receipts are going to be going to interest on the debt. And so there goes all of your other spending. And where we are is at a point where we're either going to need to have a stealth default where we don't pay people what we've promised we'll pay them, and default, or alternatively, we have huge inflation. We pay people back in dollars that aren't worth very much, or I think what we're going to have is a situation where we're going to have to print dollars in order to pay our interest. And that's going to lead to more inflation, which will lead to higher rates. And that's where we get to the thing we call a death spiral.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
New activation and upfront payment for 3-month plan required. Taxes and fees extra. Additional restrictions apply. See mintmobile.com for full terms.
Just earlier in that answer, you kind of referred to risk and how interest rates are how the market prices risk. And a lot of people don't understand that the value of equities especially are measured against the risk-free rate. And that sounds very complicated, doesn't it? But really it's all about what is the price of money and then how do you value a stock or a company above that rate. Can you just talk a little bit about that, just so listeners are clear about how that works?
Sure, you have it exactly right.
And did I get that right as well?
You nailed it. You nailed it.
Good.
We wrote
my studies paying off.
Right. You're gonna pass the licensing exam. We wrote an article on this earlier this year, and one of the questions we were getting from people is, okay, interest rates are going up. We get it. That affects the stock market. Liquidity, money's being pulled out of the system. With less money chasing stocks, you end up with this deflationary credit cycle. It's basically a way of saying we're contracting the money supply as interest rates go up. Okay, fine. But I was getting these questions from people. Why is the S&P 500 down 20% and the NASDAQ's down 30%? And if you look at the really big NASDAQ companies, a lot of the high flying tech companies, a lot of those stocks were down 60, 70, 80, some even more than 90%, right? I mean, I think, what's Facebook down this year? Something like 70%?
75%, I think, yeah.
Yeah, or Meta now. So people have asked me about that. And here's the reason for that. It has to do with duration. And that's just a fancy way of talking about the time frame for an investment. So, Phil, let's imagine I owe you $100, right? And I say, I'm going to pay that back to you tomorrow. And you think, okay, whatever, just pay me the $100 tomorrow. If I say I'm going to pay you that $100 in a year, so the duration of our agreement is a year, you might say, yeah, Gary, why don't you pay me a few percent interest? I say, okay, Phil, that's fine. But if I say to you, Phil, don't worry, I'll pay you back the $100 in 10 years, right? That's a 10-year duration. And having higher interest rates is going to massively change the value of what's owed. So it's the same thing with these big high growth tech companies. They don't necessarily have a lot of earnings right now or a lot of free cash flow right now. You're buying them because they have huge growth and you're thinking 5, 10, 15 years down the road, there's going to be a lot of earnings and cash flow then. So just like as we extend the duration of the $100 that I owe you more. It's the same thing with these companies. If you're going to get $100 of cash flow, from one of these companies 10 years in the future, as interest rates go up, the present value of that drops. Basically, the high growth tech companies are long duration assets, and that makes them more interest rate sensitive. And that's really all it is.
So you also mentioned sovereign debt. What is sovereign debt? and why are we looking at a default on sovereign debt?
Yeah. So
just go back to first principles. What is sovereign debt?
Right. Yeah, I get it. You start talking about sovereign debt and people's eyes glaze over. They say, oh my God, I don't know what they're talking about. Okay, we can make this really simple for people. Everyone who's listening, sovereign debt is simply debt that is owed by the government. So if I owe you money, it's Gary Brode debt. If Phil owes you money, it's Phil Muscatello debt. If you owe money to your bank, it's a mortgage. And if the person who owes you money, the entity that owes you money at the end of the life of a bond is a government, like the United States government, our treasury bills, or the UK government, they have what they call gilts. The Japanese have their bonds. The European Central Bank has EU bonds. When the payor, the person who owes, the entity that owes, is a government, it's called sovereign debt. It's really just a fancy way of saying government denominated debt. And that it will do a little more first principles and financial vocabulary. That debt is paid in fiat currency, which is just a fancy way of saying currency issued by a government. Now, here in the United States, that's the US dollar. And the dollar used to be backed by gold. And Roosevelt changed the valuation of that back early in his term as president. And then President Nixon took us off the gold standard, I want to say 1972, something like that. I could be off by a year. And so right now, the US dollar is backed by faith and credit, which, terrific, but that's all that means. So when we talk about fiat currency, it's government issued currency. When we talk about hard currency, we're talking about things like gold and silver, or, people will add Bitcoin to that list. I certainly would as a hard currency. Other forms of wealth would include real estate, which everybody is familiar with, right? So that's real assets. And then there's also commodity wealth, owning oil or copper or lithium or uranium. Those are all valuable, or, wheat, soybeans, right? Those are all valuable assets that you can own. Fiat currency would be the currency of your country. Sovereign debt is the debt that's owed by your country.
And you've almost explained all the asset classes in one little one little lesson there.
We cover a lot of ground here.
Yeah. So credit markets, and that's the overall term for where debt is bought and sold. And credit markets are to do with governments, but they're also to do with corporations borrowing money. And this is a lot bigger than equity markets, isn't it?
Much. Oh, yeah.
And so people don't even know about this. Ordinary people don't really know about credit markets, but they don't realize the size of it and how much effect it has on the whole of the economy.
Both government debt and corporate debt is a multiple of the size of the equity market. So when Phil is talking about credit markets, we're talking about debt or sovereign debt. And then when we're talking about the equity markets, we're talking about stocks. And the debt markets, the credit markets are much, much larger. They're a multiple of the size of the stock market.
And so what's sovereign debt default look like? Have we seen it in the past, and what are we looking at in the future?
So we have seen it, and we've seen it multiple times in multiple ways. So first of all, let's just take a quick history lesson. All fiat currency goes to zero, always. Right? The Roman Empire fell, their currency became worthless. The Spanish Empire fell, their currency became worthless. The British Empire hasn't completely disappeared, but in the last 350 years, the purchasing power of the British pound has declined by 99.5%. So I'm going to go ahead and say that's not so great. The US dollar right now is the world's reserve currency. That currency has lost 94% of its value since 1800. And the official number this year will probably show a loss of purchasing power of 7-8%. I think the real number is double that. What we have is a situation where all fiat currency goes to zero. And so when you ask, have there been defaults in the past? The answer is yes. Throughout history, everywhere, all the time. And, in many ways, people, talk about the hyperinflation in Germany in Weimar Germany that led to the rise of the Third Reich. You can end up with massive amounts of social, military, and political upheaval. Most recently, we've seen countries like Argentina and Greece default regularly, right? Argentina and Greece default more often than they don't.
They're the world champions of it, aren't they?
They really are. And the reason nobody really pays attention is they're relatively small economies. Now, if you're living there, it becomes impossible to invest and to save. It's impossible. I wrote an article earlier this year. It's impossible to buy a house in Argentina. There's no bank financing, so you need to pay cash for everything. So try to imagine a housing market where you've got to pay cash for the land, you have to pay cash for the house. There's no financing, because how do you price a currency where inflation is so bad they go out of business every 15 years or so? I think what we could see in the near future, and by near I mean the next few years, is the first default of a major economy in decades. Japan right now, I believe, is the world's fourth largest economy by GDP. And, they're in trouble. And I was writing about this earlier this week. People have said to me, wait, Japan doesn't have a problem. They can pay their interest expense. And, my response is, yeah, that is correct. The people criticizing me are correct right now. And if we assume a static world, if we assume nothing changes, then they will be right and I will be wrong. And I'm acknowledging that. But here's the issue. The issue is Japan has issued so much debt that their debt to GDP is now 260%. And they've kept interest rates right around zero for the better part of a decade. And so they have huge amounts of debt and no way to pay it off. And it hasn't created a problem because interest rates are low. Well, what we're seeing right now is, as the Federal Reserve in the United States and the ECB, the European Central Bank, and the Bank of England all start to raise rates, what that does is it puts pressure on the Japanese yen. And that can sound maybe a little confusing or intimidating for people, but it's actually really simple. Imagine that you're in Japan and you own Japanese government bonds that are paying you 0.2%. And you have the ability to buy US Treasury bonds at 3 or 4%. Well, what would you do, right? You would sell your Japanese government bonds. You would sell your yen. You'd buy dollars. You'd use those dollars to buy Treasury securities. And it's just the natural order of things. And so what we've seen is people selling their yen and buying other currencies. And what that's done, supply and demand, has made the yen very weak. And the yen has gone from ballpark, 100 yen to the dollar a while back to now it's around 150 yen to the dollar. That's a massive change. Foreign exchange markets tend not to be that volatile. That is a massive change. And so what the Japanese government is going to have to do, they're either going to have to make peace with their currency being devalued. And the reason they can't do that is Japan is an island nation without a lot of natural resources. They do have some great production capacity and a culture of doing very intense, very dedicated, detail-oriented work, right? The work they do there is amazing, but they don't have a lot of natural resources. And that means they're importing. Well, trying to import with a currency that's being devalued, good luck getting anything done, right? Your contracts are going to change literally when things are in transit. And so what they're going to have to do is they're going to have to raise interest rates to defend their currency. And wow, that's a problem when your debt to GDP is 260% and you go from interest rates of zero to something more than zero. And so that's why the people who are critical of deep knowledge investing's thinking on this have said, wait, they can pay their debt. And again, my response is now, right? If things don't change, they're fine. But I wouldn't bet on things not changing. I think they're going to have a real dilemma because either the standard of living of their people is going to crash or the government budget is going to crash. And right now they're in territory where it's pick one or both, but there's no way they get through this unscathed.
So Gary, you and I, we both spend a little bit more time on Twitter than's good for us, or FinTwit, financial Twitter. And I noticed that in one of your posts you said that the magic word when you're looking at FinTwit stock tips is because. Tell us about the because word.
Yeah, I think that's a key thing. I'm, in general, Phil, not a fan of people who make pronouncements. Stock's going up, bear's going to get wrecked, crypto's imploding. Like, people, they make these pronouncements about what's going to happen, right? Stocks are, they're going to go up, they're going to go down. We hit a resistance. The bears are going to get wrecked, the bulls are going to be crying, and people, it's like a sporting event, right? My team's beating, we're going to, no, but we're going to score, and then we'll be leading. And the ref made a bad call. Okay, right? Everybody's yelling on both sides, are yelling at Jerome Powell as the referee. And, there's all of this screaming. And I don't like it because, one, first of all, my Twitterometer is completely broken. Half the time, I can't tell if somebody's serious, if they're sarcastic, or if it's an Onion headline, right? There's no context. They just make these pronouncements. Market's doing this, stocks are doing that. These people are going to be happy. These people are going to be unhappy. And I honestly, do they mean it? Do they not mean it? And then people start writing underneath, that tweet's going to age well. Okay. Like, there's no thought behind it. To me, the key thing, and this is the key thing, what I want to do is I want to evaluate somebody's reasoning, right? To make pronouncements is not useful. And in many ways, it reminds me of the old broker's trick. So there was an old trick that brokers would do. They'd have, 1,000 names. And so they'd split them in two. And so for 500 of those names, they'd say, we think AT&T is a huge buy. The other 500, they'd say, we think AT&T is a huge sell. Whichever one was right, they'd take that 500, they'd split it. Then they'd say, we think Ford is a huge buy. We think Ford is a huge sell. And so for 250 of those people, they would say, oh, these guys have been right twice. Right? Well, they weren't right twice. They were actually wrong 3/4 of the time. And so the issue with that is, when people don't explain their reasoning, it's possible for them to say these cryptic things, saying, I meant it, I didn't mean it, you misunderstood. Okay, enough. Give me, I think stocks are going up because, and then explain your reasoning, right? I think this stock is going down because, explain your reasoning. And once you do that, it's impossible to do the broker's trick of telling half the people it's going up, half the people it's going down. Okay, we were right. See, we're geniuses. We were wrong. We were kidding. We didn't mean it. I have no time or patience.
And we were on the other side of the trade both times anyway.
Right, exactly. Right. We were right and on the other side. And, I was talking to someone, I was talking to a new subscriber the other day, and he asked me a great question. So he came in and he said, hey, I see you've got these stocks on your recommended list. He said, you've made money in them. We've owned energy all year. He said, so do I buy them now, or are they just a hold? I said, hang on a minute. If I own it every day. I could sell everything today. I could sell everything tomorrow. Everything you own, you're buying it as of every day, and you own it as of every day. And I said, the other thing is, I don't like when people do it's a hold, because it leaves people open to manipulating it, right? To manipulating the results. So let's imagine, Phil, you say to me, well, Gary, you own these stocks. What do you think? And I say, oh, Phil, I've made a lot of money in it. It's just a hold. And so that way, if the stock goes up, I say, see, Phil, I was right. I owned it. I made even more money. If it goes down, I say, see, Phil, I was right. I told you not to buy it. No matter what, I'm going to claim victory. That's nonsense. I like when people are crystal clear. This is our opinion. This is why. This is the research. This is our reasoning. Unravel it for people if you want to be taken seriously. And you need to take the risk of being wrong. And, that's the thing that we do at Deep Knowledge Investing. We explain our reasoning to people. We take a clear position. We're right most of the time, but not all the time. And, I got a text message from, a client last week. And, he said, hey, I made money in this name, and, it was because of you. And do you still own it? And I said, yeah, I still own it. Great. Glad you did well. And then he sent me a complaint. He said, I got hurt in this other name, and it was something that I had recommended and own. And what could I do? I said, yeah, look, I still own it, but the stock has done badly. And, I'm sorry it's been a negative experience so far. The best I can tell you is I still like the fundamentals. I still own it, but I wrote, I'm sorry. Because let's be clear, let's own those mistakes. Let's explain the reasoning to people. Let's give people a way to evaluate the quality of thought and research behind what's happening. Because without that, then it's just somebody giving you tickers, giving you picks, and you have no idea, as you said, what they own, why they're doing it, who they're saying what else to, whether they're going to stand behind that recommendation or whether they're going to say, oh, I was just kidding, I didn't mean it. I like when somebody says, I think this because.
And that's a real problem, isn't it? Because so many people just want the tickers handed to them on a plate. It's just like, they start realizing how much hard work it is to value a company. And they go, screw it. Just give me the ticker. Tell me what to buy.
It's kind of funny that you say that because that was one of the things that we had to deal with at Deep Knowledge Investing. Early on, I'd do these 10, 20 page reports and nobody was reading them. But if I linked to an article or did something shorter or highlighted somebody else's work or wrote a tweet on something, it could get tens of thousands of views. And so, what do you do? In our case, what we've done is we haven't changed the quality of work, but we've made the expression of that idea, the way we communicate it to people, more simple, shorter, more approachable. And for our subscribers, there are some people who just want the ticker. We keep a recommended page. And so if you go to the recommended page, it'll say, own, XYZ ticker, but it's hyperlinked. And it's hyperlinked to the report. And so for the people who want to really read the 10 or 20 page report on it and really understand it, that information is available. For the people who just want the ticker, they can pull it off the website and they know what I own and they know that I'll update it if anything changes. But yeah, communicating that to people, it's a challenge and it's something we think about all the time. But I think for us, the key point is to be accountable, is to act with integrity. If I recommend something, it means I own it. I don't recommend something that I don't own in my personal account. And I put people in a position where they can evaluate our work and they can say, I made money in this, I lost money in it. You were right, you were wrong, you're a hero, you're a goat, you're welcome, I'm sorry. And let's just act with integrity and be honest and acknowledge we're not going to be right all the time, but we're never going to be cryptic or try to cover our rear ends. In fact, the tagline on the website, I think, says the only thing we don't hedge is our opinion.
So, Gary, how can people find you? You already said it. Was it Gary_Brode on Twitter?
Yes, on Twitter. That's a great place. The other place to go is if you go to deepknowledgeinvesting.com. Mm-hmm. You have two options. Click the subscribe button. There's a free option. If you click that, you don't get access to the stock picks or, if my view on the market has changed, you're not going to get that. But you do get the weekly 5 things to know, the monthly post. It's a good way to keep track of, what's going on, general thoughts on things. For people who are more curious and more interested, we do have a subscription option right now where people can try a month of the premium for free. And we don't fool people with it. If you sign up for that, you click, it's the one that's the individual subscription. We charge people $50 a month, but it says first month free and you'll see it. When you go check out, it will show amount you're paying $0. It will be crystal clear. There are no weird, funny charges that, you aren't expecting. And it gives you the date too. We made sure we weren't fooling people. So you go to check out, it says $0 and it says, if you like it, great, stay. We'll charge you in a month. If you're not happy, cancel your subscription by such and such a date and, no problem. Either way, it's a chance for people to get a better sense of what we're doing and thinking and writing about.
Gary Brode, thanks very much for joining me today.
Thanks, Phil. Great speaking with you. I appreciate it.
If you found this podcast helpful, please tell a friend, especially if it's someone who needs to start thinking about investing for their future. You'll be helping them and helping me to keep this show on the road.
Shares for Beginners is for information and educational purposes only. It isn't financial advice and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast.
Tired of ads interrupting your gripping investigations? Good news. Ad-free listening on Amazon Music is included with your Prime membership. Ads shouldn't be the scariest thing about true crime. Just head to amazon.com/ad-free true crime to catch up on the latest episodes without the ads. Enjoy thousands of Acast shows ad-free for Prime subscribers. Some shows may have ads.